This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Zach, welcome to the show. I wish I had a background as an attorney getting into this business, but I did not. That would have been so helpful. Thankfully, you do, and for you, and we're going to talk about some of that. But let's learn a little more about who Zach is and getting into this business.
Sure. Yeah. Thank you. Thank you for having me on the show, Whitney. I'm happy to be here. I initially got into investing in real estate many years ago, about 30 years ago, 30 plus years ago. As I am an attorney, and back in the 90s, I decided to get a broker's license to broker loans, which as an attorney, it's quite easy to get. And so I started doing loans, primarily residential loans. And I got connected with a real estate investment group that was buying single family homes around the country. And so I went around the country and got licensed in 8 or 9 of the key states where this was happening, Las Vegas, Nevada, Florida, Utah, Phoenix, Arizona, key states like that. And then I was doing, hundreds and hundreds of loans for real estate investors. They'd buy homes, typically new homes. And at the time you could get like a 3-bedroom, 2-bath for $100,000. And you put 10% down, right? They had those 10% down loans for non-owner occupied. And so for $10,000, you had a 3-bedroom, 2-bath home in a fast, quickly appreciating market, and you would rent it out. And the strategy then wasn't necessarily cash flow. It was get the home and try to get to cash flow break even, but over time, through market appreciation, those homes will gain in value. And so that was the strategy. And the basic premise was, if you have $100,000, you can buy 10 homes, and just looking at historical price appreciation for homes in 10 years, those homes would be worth, your equity would be worth $1 million. So you can convert 100,000 to $1 million in 10 years. So that was the basic premise, doing lots of loans. And then I started buying homes as well. And so that's how I started getting into real estate investing. Eventually, over time, you realize there's lots of benefits to scaling up and having larger properties. So eventually I made the transition over to commercial. Right now I'm more focused on multifamily. So that's how I got my start.
What did it, transitioning from single family, multifamily, what was that jump? What did that look like for you in making that transition?
I initially transitioned to commercial, not directly multifamily, but my first, I guess you'd call it syndication, but it was mostly friends and family coming in passively. I bought a hotel in Austin, Texas. It was a Wyndham flagged hotel. It was an airport hotel. And so that was my first foray into owning commercial real estate. And it was a little bit more like owning and running a business than owning, multifamily, which isn't as hands-on intensive. It's kind of like multifamily, but you have a new tenant in every unit every day, and you have to plan for booking all of that out. But that was the first commercial property that I owned. And then after that, we acquired a couple of industrial flex office parks in St. Louis. Those are terrific properties. We still hold those. I brought in passive investors through syndications on those. But those are single tenant, triple net lease properties. And they're the types of properties where it's single story, showroom or office in the front, and then warehouse in the back, right? And then it's up to each tenant how much showroom or office you want and how much warehouse. That's why it's called flex. The building is built to really adjust the proportions that are office versus warehouse. But those are terrific properties. And even with all the distress that's happening today in the office sector.
You knew I was going to ask you that, right?
Yeah, I mean, it's an issue, right? It's definitely an issue here, but it's not an issue with industrial flex office. It's they're not building a lot more of this type of product because I don't think it's like if you were to come in and build, that wouldn't be the highest and best use because they typically are single story, so you're not going vertical. And so because of that, the supply is fairly limited and the demand is very high. I mean, we're in the St. Louis market and the demand is extremely high. And so we have no problem pushing rents. We have no problem keeping them 100% occupied. And so after that, I started buying multifamily, and our focus is value add versus ground up.
And so a tenant in a space like that, it sounds like maybe, I mean, I'm just guessing, but it's like we have a front of some kind, but then we have our own, say, machine shop or something in the back where
Yeah.
we're actually producing our widget right there, and customers come in the front door.
That's right. And we have a wide variety of tenants. We've got some regional tenants, credit tenants, and it's they tend not to be kind of the lower end kind of automotive type of industrial park. They're more high end. So for example, we have a very prominent hedge fund in one of our spaces, and they occupy a couple floors of a high rise in a very high-end area of St. Louis. But because they're trading all day, I think because of SEC requirements, they're required to have an off-site emergency location. So if there's a tornado or a hurricane and it impacts their ability to occupy and transact in their main place, they can come over to their off-site place as an emergency relocation site. And so their space in our park is fully built out like office, 100% office. It's they spent a tremendous amount on their tenant improvement build out, but prior to COVID, it was vacant. It was 100% vacant other than a person at the front occupying it for security purposes. When COVID hit, because of the shutdown and because we're not going into the office, people transitioned over to our space and it actually began being utilized. And as the COVID lockdown continued, they needed to bring more people back and expand. So we actually expanded that space. So that's one tenant. Another tenant is they're one of the premier event coordinators in St. Louis. So they put on weddings and things like that. So the front is a showroom with the different types of displays you can have at your event, and then in the back there's supplies for the events. They have a full walk-in refrigerator for flowers, etc. So it's a diverse mix of tenants in these.
Speak to your all's focus right now, the type of real estate you all are focused on now, and maybe the last kind of project that you all acquired.
Yeah, so right now we're really focused on value add multifamily. We really like that asset class. As it turns out, it seems to be the strongest asset class in where we are in the economy right now. And we prefer value add versus ground up. So we like to buy, existing multifamily properties that have maybe rents below market and units haven't been upgraded in a while and the common areas need a refresh. And that, that's our typical acquisition. So for example, our latest acquisition was a 180 unit apartment complex in Kansas City, Missouri. We love Kansas City. It's a great market. It hadn't had a consistent unit upgrade since I think 2009, kind of spotty upgrades, and the common areas need a refresh, and the rents were below market even without upgrading the unit. So that, that's perfect for us. That's our ideal acquisition.
Nice.
So we're going in. We bought it closed at the end of January of this year. We finished our model upgrade, and now we're going through and upgrading, the units as we turn them and increasing the rents and upgrading the common areas as well.
Let's dive in on I guess your specialty a little bit. You have an interesting background. I feel like you have a leg up on some groups, right? Just because of your expertise as an attorney. And we recently hired somebody who's an attorney on our staff as well. It's great to we got somebody with that expertise that can read over things, look at things, provide some guidance or even pushback, right? Or say, hey, you should ask your securities guy about this, that we wouldn't have known to ask about maybe otherwise. And so I just thought you could probably speak into that really well, for the listener who, it's like we get when we get contracts or these security docs or whatever it may be, JV agreements or all these things that are so important, right? And the language in these documents is crucial. Over the life of this project or agreement. I wanted to just dive in there a bit as you have that expertise. Maybe you could help the listener think through. And this is where some big mistakes are typically made. That are, you're looking at these documents often now from maybe a different seat, right?
Yeah.
I don't know, help us to think through some of those kinds of documents that you're reviewing all the time, and where maybe you see, in the syndication process, there's some issues, right? Or that are often happening that you're having to go back and have fixed, or, whatever, that I would normally see maybe if I didn't have somebody like that on the team.
Yeah. I mean, it's certainly very, very helpful to have the legal background. And, I did both transactional and litigation work. So I'm comfortable reviewing legal documents from a higher level. But I also I recognize the value of bringing in counsel to help us. So, I'll be the first pair of eyes from a legal standpoint in looking at stuff, but I'm not an SEC attorney. So, for example, we will bring in, of course, SEC counsel to help us draft the private placement memorandum, the offering memorandum, et cetera. But having the legal background and being able to look at these different provisions, and it's to a certain extent it's boilerplate, but there is some customization that you can do in all of these documents. And so part of it's just having that background, and these various provisions will come up and you recognize, oh, well, this may be something I want to tailor, right? So for example, when you start giving distributions to your investors, are you treating it as a return of capital or a return on capital, right? And that could have significant ramifications. And so it's various provisions like that, and thinking about, well, how is this going to apply in our actual business as we're making distributions? What are the tax consequences to us and to our investors? So that's just kind of an example. And similarly, when we're doing, most people will not engage an attorney to draft an LOI when they're thinking about putting out an offer on, say, for example, an apartment complex. Usually you're throwing out lots of LOIs and then you only get a small percentage of those. So it would be very costly to engage an attorney to do that each time. So, but by the same token, that's the first step. So you don't want to lock yourself into something that, your attorney is going to have to walk back if you happen to be the winning bidder in that deal. So.
Yeah. We do engage in our attorney for most LOIs because we just want that legal counsel up front, right? Because that legal counsel is going to be with us through the life of, or I would say, to getting to the closing table, right?
Right.
And so getting that deal there and working with seller's counsel as well, and all those things, and a lender, and and so I value their expertise in a big way, to say the least. What's your thoughts on when you all do engage in counsel, or maybe some times where you've seen other people make mistakes? I know we talked about the LOI specifically, but any other places?
Well, the purchase and sale agreement is key. I mean, when that is the guiding document that you will have to abide by as you go through your due diligence and escrow and close. And so you need to make sure that you're considering all of the, all the different provisions in there, both with respect to, what your timeline is, what your obligations are. If you're going to miss a timeline, obviously, you're putting in earnest money. Is it hard? Is it not hard? Under what circumstances can you get that money back? Are you going to get some of the rent back from the seller if there's additional rent that went to them? And similarly, if you're the seller, are you going to owe rent to the buyer, after the close? So there's lots of different provisions that can have a financial impact. The reps and warranty, that's always a battle. That's always a push and pull between the buyer and the seller. And to me, that's like, it's going to be a negotiation, and you push for as much as you can, regardless of what side you're on. But that's always kind of an issue, as you know.
Yeah. Speak to maybe give some advice on just the relationship between the operator and counsel, or their counsel. I don't know, just thinking through that relationship dynamic,
Yeah.
just from your level of expertise there, from really both sides now.
Yeah. What's nice is once you've been in the business a while, you'll establish a relationship with your go-to counsel, both for SEC, for your PPMs and your transactional attorney. So for both of those, we have our go-to attorneys, and it took us, maybe a few transactions to settle in on which one we have the best relationship with. And but now, particularly with our transactional attorney, because we're using him more for more things than just, hey, let's negotiate this purchase agreement, because we have these commercial leases, for example, at our industrial flex office parks. Well, those can be very complex. They're very different than multifamily leases, which are very cookie cutter. Each commercial lease is customized, and it takes a while to negotiate the terms and provisions of a commercial lease. And so we have a great relationship with our transactional attorney, and he really comes in and provides a lot of input there. And I will say there, we do engage him at the LOI stage. With these commercial leases, you typically will have an LOI, and again, it's very customized for the tenant and the space. And so, and the LOI will dictate the basic terms of the lease agreement. So we will bring him in on that at that stage as well.
Yeah, no doubt about it. That's I just as we think through it, there's definitely I don't know, just times where it's hard to get in touch with that attorney too. I know they're so busy, right? But man, we really need their counsel. But what I find too is, as time goes on, you just do enough deals together, and there's just the relationship builds, and
Exactly.
they know what you need, and they understand the way you operate. And you understand, like that relationship grows. Man, we just couldn't make it without ours. So now,
Yeah, exactly. And as you're saying, as the relationship grows, you get a really good flow of communication going, shorthand communication. They're in tune to what your needs are, and there's a real real rapport that's developed.
Yeah. What about how would you, just knowing what you know now, what would you do different? Say, when you first got into commercial real estate?
I probably wouldn't have bought a hotel. I mean, the hotel, we did well with it, but primarily because we bought in Austin, Texas. And this was about, I don't know, 17 years ago, approximately. And so Austin was one of the fastest appreciating markets in the country. And we went there because it's a great market for hotels. There's always stuff going on in Austin. It's the live music capital of the world. They have UT Austin. It's the state capital. They have South by Southwest, Austin City Limits. They were just building the new Circuit of the Americas Formula One track, and that was just finished like a year after we purchased our hotel, and it was very close to our hotel. So we had a lot of international travelers from there. But so we ended up doing well with it, but it was very hands-on intensive. And with hotels, you're very dependent on I think you're dependent on your management regardless of your asset class, especially if you're an out-of-state investor, which we are, right? We're in Los Angeles. We don't own anything in California. So we partner with best-in-class third-party management companies. And I will say that with the hotel, we did struggle a little with finding great property managers. And we cycled through 3 different management companies, and that impacts the business each time you have to transition to a new management company. And we were, it was very hands-on. We were flying out from LA to Austin, probably, monthly, to keep things on track. And so if I had it to do over again, I probably wouldn't do that. I think I was probably drawn to the cap rate. And I think that's an issue for a lot of new investors. They're so focused on the potential cash flow, the potential profit, and they don't weigh that against the risk of that particular asset class or that particular level of asset, whether it's like a class C or a class C minus multifamily, but look at the potential cash flow. or a mobile home park or a hotel. That was one of my big lessons learned is you really need to balance out the risk versus the potential reward and not just look at the potential cash flow, but look at how much time it's going to suck from you and whether you're going to be able to achieve that given how much, on hands-on management you want to personally have.
Yeah, I think that can be applied to so many aspects of a business. It's like we forget to think through the distraction this thing may be from like our main thing, right? Or our main skill set, even. And I feel like I've had to learn that the hard way a number of times, unfortunately.
Yeah.
It's like, man, this thing you get focused on the potential, what you think's the potential, right?
Right.
But man, you miss the risk, and sometimes I find it's there may be a bad risk as far as far as that we always talk about, but I think often a risk we don't talk about is just the distraction from
Yeah.
what you're good at, right? And pulling you away from your sweet spot, because it is going to be so much more labor intensive potentially than what you expected. What have you seen, Zach, as maybe the hardest part of the syndication process for you?
Kind of related to this getting pulled to other things that you think are going to be good, but it ends up being a distraction or it's not best suited for you. One of the things with syndication, at least with us focusing on value add multifamily, it's an incredibly popular asset class. There's lots of people chasing after that. And so what can happen is you're underwriting, you're not getting the deals, and you could get shiny object syndrome, right? And you get distracted and you say, well, this isn't working. Let me look at this over here. And so it's important to stay focused, I think, and that's very related to what we're talking about getting yourself into a pickle where maybe it's not the thing that's best suited for you, but it's something you can get right now because you're not getting the thing you're best suited for right now. Yeah, so I think having the patience, knowing that you're good at, if it's value add multifamily, knowing you're good at that, knowing that's your wheelhouse, and having the patience to continue to pursue it, and just know that you'll get the deal eventually. You just have to keep at it and to stay focused and not get distracted.
But I also want to know, why multifamily for you? Like why, I think you had said something, obviously it's a highly desired asset class, but why still pursue multifamily for you and your group?
Yeah, great question. So, I think multifamily, as it turns out right now, it's the best performing, commercial property asset class. And, one of the reasons is there's just a huge lack of housing throughout the US, a huge need for housing, and people always need a place to live. And so that's continued to drive the multifamily market versus, if you compare it to traditional office, people are working from home. There's a real difficulty here in the US to get employees to come back to the office. And so we're seeing these, high-end class A office buildings where they're turning the keys back into the lender. So multifamily, it's been a very steady, very reliable property type for us. And the reason we like value add multifamily is really the velocity in terms of how quickly we can increase the value by increasing the net operating income. So if you compare it to yesterday, we were talking about the fact that we own a couple of industrial flex office parks. Great asset class, very safe, very secure. They're all triple net lease tenants, right? And so it's very easy to predict what our net operating income is going to be. And those leases are long-term leases and typically will build in, some annual rent increase. It's very moderate in terms of the annual increase in your NOI. If you compare that, on the other hand, with acquiring a value add multifamily apartment complex where you can come in and over a couple of years upgrade all the units and significantly increase all the rents, that's going to significantly increase your net operating income over a couple of years. And so that's the velocity I'm talking about in terms of how quickly you can increase the NOI and thereby significantly increase the overall value of the property. So we find that, with this value add multifamily, we can cycle through a property in 3, 5, 7 years For some of these other property types, you're holding for a much longer period if you're trying to achieve a similar IRR.
Yeah, yeah, for sure. No, completely agree. We like that space, obviously, as well, for sure. And so, have you all done some ground up?
No, we haven't done ground up. We're involved right now in a hotel to apartment conversion project, and that's probably the most intensive like renovation project that I've been involved in to date. But we haven't done ground up. It's not something that's in our skill set. So if we were to do it, we would definitely need to bring in a partner that's very, well versed at that. And it's something we've talked about, but one of I think the attractions that we offer our investors is pretty immediate, cash flow. So particularly with these typical value add multifamilies, they're going to get cash flow, typically in the first quarter. It'll be lower than the average annual cash flow because we haven't gone in yet and upgraded the units and increased the rents, but they're still going to start getting distributions in the first quarter. And that's obviously something you can't offer investors typically in ground up,
Yeah.
unless you're pre-raising it and giving it back to them.
Yeah, no doubt. Very different animal, as far as how it, works for investors, and it's not for everyone. I guess, are there other thoughts about multifamily versus ground up that even maybe a passive investor listening should be considering? Because obviously it's like we talked about cash flow. If you're wanting cash flow in it right now, a ground up may not be the space, right?
Yeah.
And I know that typically I would say more risk, right? Because there is
Yeah.
no cash flow, right, for a long time. But any other thoughts, as far as for the passive investor listening?
Well, I think that's exactly it. There's more risk, right? Conceivably, there's more returns, more rewards, so your return should be higher for that additional risk. But, I have invested passively in a ground up apartment complex, and that was located in Los Angeles in a high-end area called Hancock Park. And it took, I want to say a year and a half over when it should have been completed to actually be completed. So, and these were very experienced people that own quite a lot of apartment buildings in Los Angeles. But you're dealing with, a lot of times it's the government that's delaying you in the permit and approval process. And that was the case here. So we were dealing with the city of LA, which is a very bureaucratic, city, and they're very slow moving. And we were dealing with the utility companies here that have their own separate bureaucracy that you're dealing with in terms of getting the electrical components approved and signed off on. And so, one of the biggest risks is how long is it going to take, and just be prepared for that, because that's going to water down your IRR. If you think you're going to get your money in a year and a half, but it takes 3 years for the money to start rolling in, that has a significant impact on your overall return.
Yeah, no doubt about it. I find that if somebody says, "Oh yeah, the ground up development, whatever the project may be, oh yeah, it'd be done in February," I'm like, "Well, what year are we talking?"
Right.
I may add a year to that, just to get my, set my expectations, because there's so many things, right? That and rightfully for any developer in multifamily value add operator as well. There's just so many things that come into play that you can't expect. We try to account for all those things, right, as much as possible, and even allow buffers. But sometimes there's just, I would even say often, there's just things that you can't.
You're running an ongoing business, and things come up, and you just have to, be ready to deal with it as best that you can, and be prepared for it. And as you're saying, if you can build in some buffer to protect you from unforeseen downsides, some contingency budget funds, that's always, I think, a good idea. And just be prepared to walk through those issues that can come up. And as an investor, I think you need to recognize that you're not investing in a bond that's going to pay out a set amount every single month, or quarter, like clockwork. It's real estate, and it can be lumpy, but at the same time, I think real estate is very forgiving. So if you have the ability to ride it out, you'll be fine.
To change gears just a little bit, Zach, with what I wonder sometimes, and you and I briefly chatted about it, but why not stay an attorney and just invest passively? Maybe active versus passive. Why go that route?
Sure. Yeah. I mean, that's certainly an option. And when I started out, I was for many, many years investing passively, right? I started out buying single family homes and I was investing passively, and they were in other locations in the country, so I had third party management managing them, and then I would continue with my job, my W-2 income, which is a great way to go if you don't want that hands-on. I just love real estate, and I've always had a passion for real estate, and so my goal was to transition out of trading my time for money. And that's what most W-2 employees are, including, high-end earners like attorneys, where I had, an hourly billable sheet that I was responsible for every day. And I had to bill a certain number of hours every day, every week. And in exchange for that, I got, a paycheck. But there's lots of advantages if you could transition over to investing in real estate, being your own boss. It frees up, one of the luxuries is it frees up your time, or you can allocate your time as you wish, and you're not tied to a timesheet.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.